Thank you for joining me. My name is Edward Hamamjian, Chief Portfolio Manager of GeaSphere, a federally registered investment advisor firm. Together with Mycroft Research, we have created this presentation to help our friends at pension funds and other institutional investors achieve better results with more predictive outcomes. We will show you a clear path to prosperity. Our methodology is simple and time-tested in valuing any business. Our philosophy has beaten the Dow in 53 of 58 years tested. We call it the price to free cash flow model. Benjamin Graham, the legendary investor and teacher to Warren Buffett and other world-class investors, used to say, there are no good stocks or bad stocks, but only cheap stocks and expensive stocks. An example of this would be in 1999, when Wall Street and their analysts were pushing the tech and telecommunication stocks as if they were a sure thing. And then late in 2002, when they had plunged 80 or 90% and their prices to free cash flow became compelling, these same firms shunned these stocks as if they were too risky. To explain free cash flow, let's look at the Main Street example, the local pizza shop. Let's assume that the owner purchased the shop for $100,000 paid in cash. After 1 year in operation, and after all expenses and taxes have been paid, we look in the register to see how much cash is left. If there was $25,000 left in the register, then we would say that the pizza shop has a free cash flow of 25%. That is $100,000 invested capital with $25,000 of free cash flow to invested capital. To value a pizza shop in the stock market, the question to ask is, how many shares does the pizza shop have? Let's assume they have 100 shares, as most small businesses start with this amount. Now we know that if we take our $25,000 in free cash flow and divide by our 100 shares, we have a price per share of $250. The question now is, what multiple do we apply to the price per share to determine the true value of the company? The value of a business is not properly determined by Wall Street or the auction system that is the market, because in a word, people are emotional and like to follow the herd. This is the underlying reason behind the peak and the bust cycles of the markets. With these principles in mind, let's review our price to free cash flow model and examine 58 years of research results. Our story begins in 1950 with a close look at the Dow Jones Industrial Average. We took the 30 stocks of the Dow starting on January 1st of each year from 1950 to 2007. We took those stocks that met our cash flow model and purchased only those stocks on January 1st of each year and then sold them on December 31st of the same year. We then repeated this process for all subsequent years for a total of 58 years. We also did the same exercise with the actual Dow Jones Industrial Average, with the only difference being that we purchased all of the stocks of the Dow. It is important to understand the difference in relative performance and what a difference it is. Thus, if we started with $10,000 in each of the two portfolios, that is our price to free cash flow versus the Dow, after 58 years, averaged 7.82% per year. Not bad. However, our price to free cash flow model averaged a staggering 22.77% per year over 58 years. $10,000 invested in the Dow starting in 1950 to 2007 would have reached a value of $679,027. The price of a free cash flow starting in 1950 to 2007 would have reached a value of $974,617,000. This means that the price to free cash flow model beat the Dow by 1,434 times. What is most remarkable about this outcome is the simple fact that it was achieved by using the same stocks of the Dow. Our model works equally well to find shorting candidates in bear markets. Our model eliminates the confusion of what stocks to buy and at what price, or more important, when to sell these stocks. As Benjamin Graham would say, we buy stocks when they are cheap and sell stocks when they are expensive. We determine these points not based on price, but based on free cash flow changes. GeaSphere and Mycroft Research have brought you our proprietary research and portfolio management philosophy to bring back sanity and reliability to pension funds and other institutional investors. We are ready to start working for you. On behalf of GeaSphere and Mycroft Research, thank you for sharing your valuable time with us. I'm Edward Hamamjian.